let's just talk about the definition of a vendor take-back mortgage.
Well, it's the type of financing arrangement that involves the seller of a property lending money to the buyer to help them purchase the property. That's a very simple definition, but it sort of, the seller becomes the bank, if you like, to get a transaction across the goal line. The importance of it is that in a lot of cases, especially as you go through cycles, you'll have cycles where conventional financing or institutional financing is readily available, or private lenders. But then there will be a time in every cycle where things will tighten up, and to get a transaction completed, many times the seller needs to take back financing. And hopefully today we'll be able to share about taking the mystery out of that and the fear out of that.
As brokers, and I've been a broker for I think about 17 years, and we've done a few $1 billion in transactions. We've never actually done a vendor take-back mortgage historically, because it was always cash the mortgage or treat as clear when money was, available, right? Now, when there's a gap between the bid and the ask, and a significant gap, one of the ways to bridge that gap is through VTB financing. Fair enough? And it's not necessarily that the seller wants to hold a mortgage, it's that the seller has to hold a mortgage to get the deal done. So how do you determine sort of the interest rate? What's the thought process of the lender, the buyer, the seller, the repayment period? How long is the mortgage for, and so on?
What we've seen is, it really depends how much the seller wants to get the deal done. I mean, typically right now in terms of pricing, you can go out and get yourself a GIC right now, 4.5%. So if you do that in terms of your cost of capital, you want to be above that, obviously, right? Otherwise, why would you give the guy VTB other than you want to sell the property? So really it comes down to, we've seen VTBs at 0%, we've seen them as high as 10%. So it really kind of depends on, on the needs of both parties and how badly they really need the VTB.
And so what do you think about, Daryl, when you're initially planning the VTB, you've got a broker here, you've structured a deal where there's a VTB, now someone's got to pay for this thing. Any comments on the legal considerations?
I think the legal considerations are one thing, because it's like any transaction. The document needed will be obviously a take-back mortgage, which is registered. It'll have the terms and everything in that take-back. There's nothing mysterious about this. I think to get counsel involved, like we talk about, it's just to make sure that the document is properly done and registered, to protect the seller and also protect the buyer.
Is a floating rate VTB good or bad, depending on whichever perspective?
It's good for the vendor, not really good for the buyer.
Right. And does it make it harder to sell that mortgage?
No, actually makes it easier to sell that mortgage. And typically you'll have a floor as well, right? So you'll have the greater
Right.
of whatever that floor is, let's say 699 or prime plus 3. And we're seeing that. So, from a vendor perspective, that's good because it's easier to sell.
Daryl, anything on closing and just monitoring and administration of the mortgage?
Typically in a take-back mortgage, the buyer would like a long-term, low interest rate, fully open mortgage. The seller wants to get his money as soon as possible. We'll give you a year, but they've got to be structured in such a way that those things can become liquid, can be sold. So it's really important at closing that the structure be such a way that mortgage is a saleable commodity in the marketplace. And to me, it's crucial. And when you're negotiating that, we can talk about that a little further.
So let's go on to the next topic, the legal and the financial considerations of VTB. Alex, just comment on the tax implications of taking a VTB versus just an outright sale where you get your money on closing.
One big benefit that's easily explainable is that you're not taking the payment up front. So you're not paying the taxes up front. You're delaying receiving that income over whatever time of the term. So you can at least push it out till, whatever the term is of the mortgage. That's a really strong advantage of it.
Right. So in a sense, it's a tax deferral strategy if you take
Yeah.
the VTB, subject to a number of rules, right?
Yeah.
But you know, you wonder what taxes are going to be in the future, right? And so you're deferring tax today at whatever the rate is, 27%, you know, or 52%, but you're deferring it to a time when taxes could be higher, right? And we're
And you can
living in a
account for it and you know, make some decisions based on that.
right,
more
right,
options.
right. Okay, so let's talk about sort of number three here, the strategies for minimizing the risk of taking back a mortgage. Daryl, we talked about, you know, collateral, the quality of the asset, stuff like that. Just generally comment on that.
Well, Rich has brought it up a couple of times.
Sure.
There's added security, the strategies. It's probably a good thing for most people that are negotiating take back mortgages, that they negotiate those added clauses from a seller's perspective, and in the take back mortgage, that they understand, and they're dealing with people that understand what they need to know to take back and protect their interests. Yitz has brought it up a couple of times in this conversation about the added clauses that are needed to bring security to the take back mortgage holder.
Right. It's maybe talk a little about the underwriting, you know, of a mortgage. How do you look at it different than, you know, maybe the way a buyer would underwrite the value of a building?
You want to also underwrite the buyer a little bit. I don't see that done enough times, but you want to know what you're getting yourself into. Can he afford the payments? Is the apartment building itself going to be able to make the interest payments, or is the guy going to have to dip into his pockets, and can they make actually those payments or not? So you do want to look at their credit, and you do want to kind of look at their financials just to make sure that they can actually afford this and walk into this and refinance, and make sure that whatever their exit strategy is makes sense. Otherwise, if it doesn't, you as a vendor on the VTB have to make a decision. How am I going to organize the mortgage? Am I going to give them, you know, am I going to give them however loan of value you want to go? So I do think you want to look at the buyer. You know the property well, so going to underwrite the property isn't a big deal from a perspective. I would say just, you know, really make sure you understand who's buying this property.
Okay, let's change topics here. You know, these VTBs are tradable financial instruments. Fair enough. It's not like real estate. There's no toilet to plunge. There's no roof to worry about or things like that, right? What you've got here is a financial instrument, and they compete in the marketplace with GICs, bonds, and stocks. Fair enough. It's sort of in that same group investment. So let's talk about sort of weighing the pros and cons of, let's say, keeping a mortgage versus selling a mortgage versus exchanging that mortgage for something else, or maybe even borrowing against that mortgage. You follow, Daryl? These are tradable instruments. I mean, people don't think that way necessarily.
They're certainly an exchangeable instrument, and it's how you price that mortgage if you're buying or if you're exchanging or borrowing against it. I mean, it brings up prime rate. I always, as you know, Derek, I always focus on prime rates right off the bat when we're dealing in the marketplace to determine where we are in any given time frame. But there is definitely opportunities out there you can keep it and just put it away and get payments every month or whenever you negotiate. You can sell it in the marketplace to raise that cash if needed. You may be taking back a mortgage that you have to sell on or before closing. Make sure that in your agreement of purchase and sale that it's a condition that you sell that mortgage on or before closing, so that you can satisfy other requirements that you have. You can exchange that mortgage for all kinds of different assets or whatever you want to go, and you can borrow against it because you don't have to. You know, you may have a face of so many dollars, but you can borrow against it to a certain percentage, and lenders will gladly do that because they're looking to place money too. So as long as your mortgage is well written and well structured, there is a lot of different places you can go with it.
So Daryl, I've sold an asset, and I'm holding a $5 million mortgage at 7%. Fair enough. And maybe I don't want to own that mortgage anymore, but I like apartments, I like retail, I like land. What could you do with that $5 million mortgage?
I could exchange it as a down
Lots.
payment into a much larger property, I could exchange a part of it for cash and or something else. What people don't really understand is the power of a well-structured mortgage and what you can do with it and in the afterlife of the actual transaction. The world I live in says mortgages well-structured are almost like cash, and they can have a lot of different areas that you can go with them. And it's just the world I live in, and I see it every day. It's a very interesting way to transact business when you can bring some added equity besides the cash only to a transaction. So
Right,
you can exchange it for all kinds of different things. A lot of people will use a mortgage that's well structured and use it as a down payment to go into a larger asset. They will sell part of it. That's an exchange also, by selling part of it and keeping maybe the mezz portion of it if there is some deemed risk by the buyer. Just keeping that, expanding your mind about what you have, if it's done properly, is I think a powerful tool to use going forward in other opportunities.